Hello everyone. I will give a short overview of my group's final year project. The core concept of our project is opinion dynamics model, and we intend to use this model to simulate the recent GME short squeeze event. I will first give a short introduction to the GameStop short squeeze event, which occurred earlier this year, and then introduce our motivations to simulate this event with opinion dynamics model. The event took place during January this year, and the most obvious feature of the event was the price hike. Price suddenly rose from just $17.5 per share on the 4th of January to an unbelievable $347.51 per share on the 27th. While it is debatable what was the actual cause of such sudden price hike, the popular answer seems to be retail traders, especially those that are savvy users of online stock trading social media forums such as Wall Street Bets from the popular platform Reddit. Typically, these retail traders are irrational, as they ignore the fundamentals of firms when investing. They're also social media savvy and likes to bandwagon trends they see on social media. While making money from investing is important to these people, having fun while trading seems to prioritize in certain situations. As the core of our project is to study and apply opinion dynamics models, we thought it would be interesting to apply the model to these retail traders and simulate the price hike of GameStop during January and February earlier this year. So I've just explained half of our project title, the GameStop short squeeze, and in this section, I'll explain the other half, which are opinion dynamics models and price formation model. I'll explain these two models in the context of our project, beginning with retail traders who are the focus of GameStop short squeeze. The opinion evolution of these retail traders are especially important for us, and our hypothesis is that most retail traders are stubborn, and among them exist some key opinion leaders who are followed by the rest of them religiously. In order to model this opinion evolution, we have to use the opinion dynamics model, which models the interaction between individuals in a system and simulate the evolution of opinions within such a social system. The opinions generated by this opinion dynamics model is the trading action of our retail investors, which are either buy, sell, or hold. The trading action of individuals can then be fed into the price formation model in order to generate the price evolution of the security that is being traded, and in our project, that security will be GameStop shares. In the end, we can obtain a time series of prices, which ideally would match that of the real world. Next, I'll talk a little more in details regarding our project. The situation we're trying to simulate is as follows. We have two initial and separate networks with two types of agents. On the right-hand side, we have the trading forum, and within it are the potential retail traders. On the left-hand side, we have the stock market of GameStop, and it includes people who own GME stocks prior to the short squeeze. We assume that these people are rational and fundamental traders. Over time, retail traders buy into the market sequentially so that the stock market will contain more and more retail traders, as seen by the graph here. And with this dynamics in mind, we can talk a little more on the technical terms. On the left-hand side, we have an rational agents network. Within this network, agents have their own opinion dynamics model, which is the bounded confidence model. These agents influence each other's opinions, and as a result, price fluctuates. The arrow represents the relationship between traders. And on the right-hand side, we have the stubborn agent network, which represents the trading forum. They are stubborn in the sense that their opinions will never change, and in our case, they hold the homogeneous view that GameStop price will only go up. These agents are added to the rational network sequentially over the simulation process, thus making a network of mixed agents, as shown in this graph. The mixed network thus represents the stock market during the price hike, where retail traders continue to enter and drive up the price. Rational traders' behavior are modeled by the bounded confidence model mentioned earlier, whereas retail investors are stubborn and thus inherently irrational. The behaviors and opinions of these retail traders can influence rational agents, but not vice versa, as indicated by the arrows. The opinion dynamics of these two types of traders create an interesting price evolution under different parameter settings. For instance, altering the opinion dynamics model setting or the final ratio of two agents in the network can significantly affect the price evolution, as we discovered. Thus, the relationship between parameter settings and price evolution is the core of our project, and we've certainly made interesting discoveries. To conclude our project, we have simulated the GameStop short squeeze event using three key components, as shown on the screen. This simulation model successfully recreated the price hike and uncovered relationship between stock price evolution and our model parameters. The use of price formation model, opinion dynamics model, under a dual network setting is a novel approach to analyzing a relatively new phenomenon thanks to the rise of social media and current socio-economic outlook. And we are interested in seeing more similar approach in the future. And thanks for watching this video.